There's a company you've probably never heard of that makes the chemicals that make your iPhone, your GPU, your EV battery controller, your Wi-Fi router, basically anything with a circuit board inside it, actually work. They've been doing it since 1785. And this morning their stock is sitting just pennies below an all-time high after nearly doubling in the past 12 months.
Element Solutions Inc., ticker ESI, specialty chemicals for electronics manufacturing. Today they reported Q1 2026 earnings. Revenue of $738 million beat estimates by 2.5%. EPS beat by 17% on a GAAP basis. The electronics segment is firing.
Today on Charged Alpha, we're going deep on one of the quietest beneficiaries of the AI infrastructure boom. Let's go. Section 2, Company Overview. Lana, Element Solutions. Most people have never heard of this name. What do they actually do?
They make the specialty chemical formulations that enable electronics manufacturing. Think of it in two buckets. The first is the electronics segment, which is about 2/3 of revenue. This segment sells proprietary chemistry to printed circuit board manufacturers, semiconductor fabs, and electronics assemblers. When TSMC or Samsung or a leading PCB factory needs to plate copper interconnects, fill vias, apply solder, they're using Element Solutions chemistry.
So every time NVIDIA ships a data center GPU, ESI's chemistry is somewhere in the supply chain.
Multiple times, actually. The chip itself, the package it sits in, the circuit board it gets mounted on, the assembly solder, ESI has chemistry at each step. The second segment is industrial and specialty, which is about 1/3 of revenue. That's surface treatment chemicals for aerospace and automotive, printing chemistry for flexible packaging, and hydraulic fluids for offshore energy. More diversified, slower growth, but steady.
The company history is interesting. The founding year in the records goes back to 1785, but the modern version was built through a series of acquisitions under the Platform Specialty Products name, then rebranded to Element Solutions in 2019 when the current team decided to double down on electronics.
That rebranding was strategic, not cosmetic. The company divested industrial assets that didn't fit the electronics thesis and concentrated capital into higher-margin electronics chemistry. The result is a business that looks very different today than it did 5 years ago.
Headquartered in Fort Lauderdale, Florida, 5,300 employees serving customers in every major electronics manufacturing hub: the US, Japan, South Korea, Taiwan, and China. The moat is deep. Once a semiconductor fab qualifies your chemistry into their process, switching to a competitor means months of requalification and production risk they simply won't accept.
That qualification stickiness is the heart of the competitive moat. It also means ESI's revenue base is inherently recurring. Customers don't switch unless something goes catastrophically wrong. Section 3, CEO background.
CEO is Benjamin Glicklich. He's been in the chair since 2019, 7 years now. Joined the company back in 2014 as the head of corporate development, overseeing the M&A machine. Law degree and MBA, started his career in management consulting and corporate strategy.
The strategic pivot to electronics first is really his defining accomplishment. When he took over, the company was carrying net debt at roughly 5 times EBITDA and had a sprawling collection of specialty chemical businesses without a clear organizing thesis. 7 years later, net debt is down to 2 times EBITDA, the portfolio is focused, and the stock has reflected that transformation.
The stock doubling from its 52-week lows is partly the market catching up to what he's been building. The criticism you hear is that the electronic segment tailwind has been cyclical as much as secular, and that when PCB or semiconductor demand turned down in 2023, revenues felt it. Glicklich would argue the AI-driven demand is different in character from the consumer electronics cycles of the past.
That's the debate we'll get to in the bull and bear case. Section 4, the numbers.
Lana, walk us through the numbers.
Let's start with where the stock lives. ESI is trading at $38.15, within a hair of its 52-week high of $39.60. The 52-week low was $19.12. That's essentially a 100% move in 12 months. The market has dramatically repriced this company.
What drove that?
The AI narrative applied to the supply chain. Every company in the semiconductor ecosystem got repriced upward as investors connected the AI compute build-out to the chemicals, materials, and equipment that enable it. ESI was late to get that credit, but eventually did.
Valuation.
Here's where you have to be careful with GAAP metrics. The trailing GAAP PE is 48 times, which sounds expensive. But ESI's GAAP earnings are heavily depressed by amortization of acquired intangibles from the M&A era. They're amortizing roughly $150 million per year in non-cash charges through the income statement. Add that back, and the adjusted earnings picture is far more attractive.
So what's the right number to use?
Forward earnings. On 2026 consensus estimates of approximately $1.75 per share, which is the adjusted figure analysts actually use, the stock trades at roughly 22 times forward earnings. For a specialty chemicals company with a structural electronics tailwind, that's a reasonable multiple. PS is 3.6 times. EV to EBITDA on a trailing basis is 22 times. But forward falls meaningfully as EBITDA expands.
Revenue and income.
Q1 2026 came in at $738 million, up 24% year over year from the $594 million in Q1 last year. Gross profit of $314 million implies a gross margin just above 42%. Operating income of $103 million gives an operating margin of 14%, improving from the trailing average. Net income of $68 million on roughly 243 million diluted shares gives GAAP EPS of 28 cents.
Cash flow.
Trailing 12-month operating cash flow of approximately $290 million, free cash flow of $228 million. Q1 cash flows can be lumpy due to working capital builds. The company invested in inventory ahead of the strong seasonal demand in Q2 and Q3 for the electronics segment.
Balance sheet.
Cash of $627 million against total debt of $1.6 billion. Net debt of approximately $1 billion. Net debt to EBITDA of 2 times. That's a manageable leverage profile for a specialty chemicals company with steady FCF generation. Interest expense runs about $55 million per year. Total assets of $5.1 billion, equity of $2.7 billion. Overall, Element Solutions' financial health is solid. Strong free cash flow generation, improving margins, and a balance sheet that has been consistently delevered from the 5 times leverage of the platform specialty era. The primary complexity is the GAAP versus adjusted earnings gap, which requires investors to look through non-cash amortization to assess true earnings power. Section 5. What the Street Thinks.
What does Wall Street say?
Consensus is strongly buy. 14 analysts covering the stock, 11 buys, 2 holds, 1 sell. Average price target of $45, implying about 18% upside from current levels.
Who's been most vocal?
UBS has been consistently buy, reiterated in February. KeyBank is overweight. Truist has buy. Mizuho and BMO both carry outperform. The bear in the room is Goldman Sachs, which has maintained neutral. Their view is that the AI tailwind is already priced in and that the China headwind from trade policy is underappreciated.
And the Q1 earnings themselves.
Strong across the board. Revenue of $738 million beat the $720 estimate. GAAP EPS of 28 cents beat the 24-cent estimate by 17%. The electronics segment was the driver. Management called out over 20% volume growth year over year in semiconductor chemistry. Management guided full-year 2026 revenue to approximately $3 billion and kept the adjusted EBITDA margin target at 18 to 19%. Section 6. The Bull and Bear Case.
Let me lay out the bull case. The AI infrastructure boom is not a passing theme for ESI. It's a structural change in their addressable market. Every NVIDIA Blackwell chip, every AMD Instinct accelerator, every Broadcom network processor gets packaged and assembled using chemistries that ESI sells. And as chips move to more complex architectures, three-dimensional stacking, chiplets, advanced packaging, the chemical content per device goes up. ESI isn't just riding the AI wave, it's embedded in every layer of it. Second tailwind, EVs. A conventional gasoline car has about 1 kilogram of circuit boards. A modern EV has 3 to 5. Every incremental EV rolled out globally is more ESI chemistry per vehicle. The global EV market is still well below full penetration, meaning this tailwind has years to run. Third, the valuation makes sense. 22 times forward earnings for a company with structural end market growth, recurring customer relationships, and improving margins. That's not expensive. Entegris, the most comparable pure play, trades at 40+ times. ESI has room to re-rate.
Now the bear case. The electronics segment is cyclical. Yes, the long-term story is compelling, but in 2023, when semiconductor inventory corrected, ESI's volumes fell meaningfully. The stock went from the low 30s to below $20. If AI spending slows, if TSMC cuts CapEx guidance, if the PCB cycle turns, ESI revenues will feel it fast. The secular story doesn't eliminate the cyclical exposure. China is a real risk. ESI derives significant revenue from Chinese electronics manufacturers, and the U.S.-China trade environment is deteriorating. Tariffs on specialty chemical inputs, export controls on advanced semiconductor processes, and potential customer loss in China if geopolitical tensions escalate could hurt both segments. Management flagged this in Q1 guidance, and the GAAP earnings complexity is worth noting. The 48 times trailing GAAP PE is not just an accounting quirk. It reflects that ESI spent years acquiring businesses at premium prices, leaving a large intangible asset base on the balance sheet. If those acquisitions don't continue to generate returns above their cost of capital, investors are carrying real economic dilution, even if it's spread across a non-cash amortization line. Section 7. Peer comparison.
How does ESI compare to its specialty chemicals peers?
3 closest comps. First is Entegris, ticker ENTG. This is the premium comp. PFES of 4.4 times, revenue growing nearly 15%, very focused on advanced semiconductor materials. The higher multiple reflects deeper integration into advanced node chip manufacturing. ESI trades at a discount to Entegris despite having a comparable electronics narrative.
So ESI is cheaper than its closest pure-play peer.
Meaningfully cheaper. Second comp is Quaker Houghton, KWR. Industrial process fluids and specialty chemicals for metalworking and automotive. PS of 1.8 times, revenue growing under 3%. The lower multiple reflects the slower growth industrial mix. This is where ESI would trade if the market stopped believing the electronics thesis.
And the third?
Ashland. Specialty ingredients for pharma, personal care, and coatings. PS of 2 times, revenue essentially flat. Very different business model, but similar revenue scale. ESI at 3.6 times P/S sits between the pure-play electronics premium and the diversified industrials discount. The positioning makes sense given that ESI has the electronics upside story, but also the industrial drag. Section 8. Options activity.
What's the options picture?
Formal put call and implied volatility data wasn't available for this episode. What we can say is that ESI carries a beta of 1.23, meaningfully more volatile than the average stock. For a company at a 52-week high heading into an earnings print with strong analyst sentiment, the options market was likely positioned with a bullish tilt. The 17% EPS beat and revenue upside should have rewarded those positioned long volatility or directionally long.
A double from the 52-week lows is the kind of move that attracts momentum options traders.
Exactly. And the stock's proximity to all-time highs heading into the print created a momentum-reinforcing setup. Whether that continues into Q2 depends on whether the electronics segment growth sustains. Section 9. Insider activity.
Insider moves?
Quiet. One small insider sale in late 2025, consistent with routine tax planning rather than bearish conviction. No major buying or selling ahead of the Q1 print. CEO Glicklich's equity compensation is tied to long-term performance metrics, aligning his outcomes with shareholders. The company's institutional shareholder base, Fidelity, Mariposa, and major index funds, has been stable.
Quiet insiders at an all-time high is actually neutral to positive. It means nobody at the top is racing for the exit. Section 10. Risks and watch points. What are the main risks and metrics to watch?
3. First, electronics segment volume growth. If that metric starts decelerating and management guides to lower than 20%, the multiple will compress. Second, China revenue as a percentage of total. Any disruption from trade policy will show up first as an inventory build at Chinese customers. Third, EBITDA margin trajectory. The company is guiding 18 to 19% for the full year. Watch whether quarterly EBITDA margins are tracking to that range.
And the key forward catalyst?
Full year 2026 guidance confirmation. If ESI can report through multiple quarters with electronics growth sustaining and margins expanding, the market may re-rate toward a higher multiple. If the cycle turns, the stock will give the rat run quickly. Section 11, the bottom line.
Let's land this.
Element Solutions is a well-positioned specialty chemicals company at an inflection point. The electronics segment is capturing genuine structural demand from AI, advanced packaging, and EV manufacturing. The balance sheet has been meaningfully improved under Glicklich. The forward valuation at 22 times is not expensive. The Q1 beat demonstrates the thesis is executing, not just anticipated.
The risk is real, though. Cyclicality in the electronics segment, China trade exposure, and a stock that has already doubled. There's less margin of safety than there was a year ago. The bull case requires the electronics tailwinds to sustain into 2027 and beyond.
The key metric to watch: electronics segment organic revenue growth rate and adjusted EBITDA margin. Both together confirm the execution story. Section 12, closing quote CTA.
We'll leave you with a quote from CEO Benjamin Glicklich from the Q1 2026 earnings call. Our electronics business continues to benefit from structural tailwinds in AI, advanced packaging, and electric vehicles. The breadth of our chemistry portfolio, spanning circuit board fabrication, semiconductor packaging, and electronics assembly, positions us to capture growth at each stage of the electronics manufacturing ecosystem. We remain focused on disciplined execution and delivering margin expansion for our shareholders.
A company that touches every layer of the electronics supply chain, riding the AI infrastructure wave, and trading at a reasonable multiple after a massive run. The question is whether the run has legs or whether the cycle is about to turn.
That's going to do it for this episode of Charged Alpha on Element Solutions, ticker ESI. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas. Section 13, outrow, required disclosure.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.